I'm John Lesky, recently retired personal financial planner and founder of FinHealth, a tool to guide you to your financial independence. In the FinHealth framework, your growth asset allocation ratio is regarded as one of the 5 key indicators of financial independence. Our video blog, The Growth Asset Allocation Ratio, provides an overview of the importance of your target growth asset allocation ratio decision. In this 4-part series, I want to drill down further into asset allocation and provide some responses to the following questions. 1. What is asset allocation and why is it important? 2. How do you make the target asset allocation decision? 3. What is the appropriate way to measure your asset allocation? And 4. How do you move from where you are now to your target asset allocation? I'll use the Barber family, discussed extensively in our What is FinHealth video blog series, as a case study, and the FinHealth personal finance software to hopefully clarify the discussion. In this video, we'll focus on the first question: what is asset allocation and why is it important? At the highest and most important level, your asset allocation is the division of your investment wealth between defensive assets and growth assets. Defensive assets are low risk, low expected return investments like cash and fixed interest securities. Growth assets are higher risk, higher expected return investments like domestic and international shares and property. We view this high-level asset allocation as the most fundamental measure of your investment risk exposure. The higher your allocation to defensive assets, the less variability there will be in the range of your future wealth possibilities. But this lower variability comes at the expense of expected, but not guaranteed, lower investment returns. A 75% defensive, 25% growth investment portfolio is expected to have considerably less variability but lower returns than a 25% defensive, 75% growth portfolio. Return differences between defensive assets are primarily driven by exposure to credit and maturity or term risk. That is, the better the credit risk, that is, ability to repay, and the shorter the term to maturity, when repayment is due, the lower the expected return. The FinHealth view is that the purpose of holding defensive assets is to reliably reduce the overall variability of your investment portfolio, rather than deliver higher returns. We don't encourage the pursuit of extra returns by opting for higher credit risk or long maturities. Historically, the premiums haven't justified the often considerable additional risk. If you need higher returns, the growth asset classes of shares and property offer higher expected returns for their higher risk. We purposely exclude investment offerings such as commodity funds, private equity funds, and hedge funds from the growth asset classes. Generally, such investments have 1. An inadequate or unclear source of expected return for risk-taking. You should see our Is Bitcoin a Good Investment video blog for further discussion on the expected return. 2. A lack of cost-effective diversification. And 3. High fees and expenses that are not reliably linked to expected returns. On the assumption that your investment portfolio is well structured, consistent with the FinHealth financial independence indicators, that is, it's highly diversified both across and within selected asset class and is tax aware and is low cost, your mix between defensive and growth assets will be the primary driver of both 1. Your expected investment returns and, more importantly, 2. The variability in your investment wealth at any time in the future. Research of the world's leading financial economists has shown that attempts to enhance investment returns through share selection, that is, stock picking, or switching between asset classes based on forecasts of expected returns, that is, market timing, don't reliably add value. To examine the link between asset allocation and future wealth possibilities, the table on the screen compares the historical performance of a 100% defensive, 0% growth portfolio, the high defensive portfolio, a 50% defensive, 50% growth portfolio, the balanced portfolio, and a 0% defensive, 100% growth portfolio, the high growth portfolio, for the 30 years to 30 June 2021, using well-accepted indices for asset class returns. Over the period from June 1991 to June 2021, the high defensive portfolio returned 3.8% per annum after inflation, with volatility of 3.7%. This means that in any year, there was a 68% chance that the actual return could vary by plus or minus 3.7% from the average, that is, between 0.1% and 7.5%. In contrast, the high growth portfolio returned 6.8% per annum with volatility of 12.4%, suggesting a 68% chance that returns could vary annually between minus 5.6 and 19.2%. With the benefit of hindsight, the high growth portfolio provided the highest return, but the higher volatility suggests considerably wider variation in annual returns than for the defensive portfolio. If we assume that in future the portfolios have the same expected but not guaranteed returns as the historical returns and the same volatilities, we can simulate potential growth of wealth paths for any period based on an initial investment. The charts on the screen now show the range of possible wealth accumulation for an initial $10,000 investment over a 30-year period for both the balanced portfolio and the whole high growth portfolio, based on 10,000 simulations. Features to note include 1. The range of possibilities for the balanced portfolio are considerably narrower than for the high growth portfolio, reflecting the increased certainty that comes with lower volatility. 2. The middle, average and 90th percentile for the high growth portfolio are higher than for the balanced portfolio, driven by the higher expected return. And 3. For downside situations, represented by the 5th percentile, the balanced portfolio is less susceptible to the investment falling below its initial value and results in higher wealth after 30 years than for the high growth portfolio. The lower variability and downside protection that an increased defensive asset allocation offers come at the expense of foregoing potentially higher long-term wealth. But it should be always borne in mind that while historical variability may be a reasonable guide to future variability, future expected and actual returns may be considerably lower or higher than past returns. So, asset allocation is about the trade-off between risk, as measured by the potential variability in investment portfolio valuation, and return, as measured by the potential growth in the value of your investment portfolio. Having briefly explained what asset allocation is and its importance, Part 2 of this 4-part video series considers how to choose the right asset allocation for you, the asset allocation decision. While the choice is a mixture of both art and science, we believe that the ability to adhere to a disciplined investment strategy is highly dependent on understanding the basis for the choice and then committing to it. So, see you in the next video in 2 weeks' time. Please provide any comments or questions below. Finally, thanks for